Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax-efficient or tax-free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no-cost, no-obligation consultation with me. Enjoy.
Good morning, everybody. It's Tuesday, 11/23rd, November 23rd at 10 a.m. I want to welcome everybody to this week's webinar. I hope there's some good information for you today. I'm really excited about this week that we have. I want to wish everybody, I'll say it again, but if you have big plans for Thanksgiving or if you just have small plans for Thanksgiving, I hope everything goes great for you. It's a short week for us. We'll be wrapping up Wednesday afternoon, and we're closed Thursday and Friday in the office. So if you need anything, today's the day. Our staff has been scrambling, working very, very hard over the past several weeks, if not the past month. As you may remember, our timeline got shortened significantly by about a month for Roth conversion. So, this tax efficiency is a huge part of our practice. And nearly everybody is in the middle of Roth conversion. Some end it this year, and that's great when you see folks get to the end. They've done their final Roth conversion for the year, for their lives. They're never going to have to pay tax on this money ever again, and that's really exciting. So really big years for some folks and busy times. So my staff isn't on this webinar because they're still very busy, but I want to just kind of publicly thank the great job everybody did, including, of course, Jessica and Emily, but Himiko, who joined us in January last year, she jumped right in and was part of the Roth conversion process, because it's not just about signing some documents and sending them off to their respective custodians. It's about preparing everything and having conversations with clients and accountants and really honing down on those last numbers and what's appropriate for the year. Because like I said, I've talked to other folks, and I was on a coaching call with somebody, I guess last week one day, and we were talking about the Roth conversion process, and he says, well, I follow what the plan was when we started with it. And I said, well, you can't do that. There's gonna be issues either way, either higher or lower. That's gonna cause the Roth conversions to go higher or lower every single year without fail. There's very, very few of our plans that are, 100,000, 100,000, 100,000. It stays that way because there's always something that happens. And that's just part of it, and that's why you have us, right? So it's not just filling out a form and getting that Roth conversion done. It's filling out, it's finding the best number, having everyone be comfortable with that number, and that's a big part of it. Because as I've always said, and you hear me say, it's really easy for me to say you should do a $250,000 Roth conversion this year, and that means you write a check for $50,000 to the IRS, and that's easy for some people to do and not so easy for other people to do. So there's sometimes, a little bit of psychology involved in this, right? And having people be comfortable and understanding that what the pros and cons are. If you don't convert as much this year, you add risk to the schedule. And, as I said, we had a few folks who entered their Roth conversion journey this year. And if they would have delayed, every year that you delay these conversions, you add risk, tax rate risk. Taxes could potentially be higher for every year you delay. So what's that cost going to be? So there's that part of it, and then there's follow up, right? We have to make sure we check with each one of the custodians. Our spreadsheet starts with the client name, the suggested Roth conversions, the actual Roth conversions, notes, and times when they're linked to accounts and followed up on an e-money, and then confirmed That's part of it. Before we turn that section green, green means that client is completely done. It has to be confirmed, because we've got a motto in our office that there's only one group of people we can trust to get things done right, and that's us, right? Because when you send it off into the ether, you can't always trust that it's done. So there's a lot of steps, and I think we just have one or two. One person waited until yesterday to give us the word, so we're right on the wire with her, but we should be good. So I want to again publicly thank everybody, and it's a lot of work. So if you are so inclined, send an email to the staff and thank them for the work. If you're so inclined, you don't have to, but I know they'd appreciate it. All right, so we're going to, let me pull up my notes here. Today on our planning topic, we're going to talk about Roth conversions and IRMAA, the effect on IRMAA. What is IRMAA? The income-related monthly adjustment amount that is applied to Medicare, your Medicare premium. So if you're now reaching 65 or 65 or older, you're planning or receiving Medicare benefits. And there is an amount that you will have to pay over the base amount, which we learned is significantly increasing for next year. We talked about that at our last webinar. That's a huge amount, going from $140,000 to $140 a month to $170 a month. Big amount, and I'm really surprised at where how they applied that increase. They're applying it right to the folks who are paying for Medicare, but IRMAA can increase over that, right? And that is an income-related monthly adjustment amount. So the higher income you have, the more IRMAA you pay. And we're going to look at the pros and cons of paying that IRMAA. Why? Because Roth conversions are likely to create either trigger IRMAA for you or create it to be a higher amount. And just like anything else, it has to be beneficial. Just like when we show you in that before and after comparison in the beginning, or in your financial plan as we move along, the benefit of doing Roth conversions as opposed to the drawbacks. And I was talking to a couple people who, one person in particular, I'm not sure if he's on this webinar today, but who we showed the before and after comparison, and it was, I think, $6 million difference for him in being tax efficient at age 85 compared to continuing on the tax deferred paradigm. That's significant. You know, often it's $1 million, $2 million. Sometimes it's hundreds of thousands of dollars. And sometimes it's also the difference between your money running out during your lifetime and your money still being, still having an amount available when you're no longer here. So tax efficiency can change lives, no doubt about that. You've got to do it now, though. There's no delaying anymore. 2021 is really in the rearview mirror for most people with Roth conversions right now. So that year is gone. If you haven't done your Roth conversions, it's likely that you won't get it done for this year unless you're on it today, right? And you're able, and your custodian's going to commit to it and guarantee that it's done for you. You might be able to squeak it by, right? But you're taking a chance. So anyway, let me get off of that soapbox. So today we're going to talk about Roth conversions and IRMAA for our financial planning section. And first of all, just let me check in. Can everybody hear me okay? Just raise your hand if you can hear me okay. Wonderful. Thank you so much, everybody. All right. Our next webinar. So next week, we're going to talk about qualified charitable distribution. So this is something, as we're coming up again to the end of the year, that we're talking a lot to folks. And when we go through our financial planning and particularly our account segmentation, we're often seeing an amount in the what we call legacy longevity column. That what that means is that folks aren't likely to use that money during their lifetime. It is available to them if they need it for things like much higher inflation, long-term care, just additional spending that they may want to do. But it's also likely that it will pass to the next generation. So we're having a lot of conversations lately around charitable giving. And one of the things that you can use during your lifetime, so if you have $1 million, let's just say in an IRA, that you say, I am likely not going to use that, and we have a discussion, and I will tell you that if it's likely you're not going to use that money, you probably don't want to do Roth conversions with that. If that's going to be legacy money that you're going to leave to a charity, specifically, let me rephrase that. If that is money that you're going to leave to a charity, not to your kids, if you're leaving it to your kids or family members, convert it. It's a gift to you. It's a gift to them if it's tax-free. But if it's going to go to a charity, well, we can manage that two ways. First of all, don't convert it, right? No reason for anybody to pay tax on that money. If the charity's not going to pay tax, why would you pay tax? And you can use qualified charitable distributions. So that is after age 70 and a half, I know it's different than RMDs, it's crazy, but after you turn 70 and a half, you can make a qualified charitable distribution, pay it directly to a charity, and those distributions are not taxed at all. They don't go on your tax return. They're not taxed at all. So you don't have to qualify for the AGI that comes along with normal charitable distribution. So that's a really great tool. So we're going to talk more about that next week. So let's jump into the slot report. And this first question is about QCDs, qualified charitable distributions. Again, that's going to be our topic next week. This is from Sarah Brenner. And the question that Sarah answers is, can someone take an in-service withdrawal from their 401k and directly transfer it to their IRA, then take a QCD from the IRA to satisfy the RMD attributed to the 401k? So remember, let me decipher that or explain that. So the 401k is a retirement plan, and IRA is an individual retirement account. The two are very, very different. While most of us think they're the same, right? This is pre-tax money, or I got a deduction for that money that I've saved. Retirement plans and IRAs have completely different rules, and they have to be treated separately. There are RMD requirements in a 401k, and you cannot, and your IRAs as well, and you cannot aggregate the two. You can combine multiple IRAs, you cannot combine multiple 401ks, and you cannot combine 401ks and IRAs. So this person's asking, can I take my an in-service withdrawal from the 401k? So they're still working. This person's 72 years old, still working. Transfer to an IRA, take the QCD from the IRA, and satisfy the RMD amount that's attributed to the 401k. Now, you're gonna ask, and it's in the next sentence. So wait a minute, if this person's still working, they don't have an RMD of their 401k, but this person does because he owns more than 5% of the company. So if he owns more than this is a him. If he owns more than 5% of the company, then the still working exception does not apply. Now, if he wasn't an owner of the company and just working, he actually wouldn't have to take an RMD out of that 401k. So he's trying to take the in-service distribution from the 401k, roll it to an IRA, and then do a qualified charitable distribution out of the IRA to the direct to the charity. So he's trying to kind of circumvent the rules of the requirement distribution from the 401k. So Dan, his name's Dan. I initially don't think it can work, but I figured I would ask the experts of IRA planning, he says. And Sarah writes back to Dan, it's good to think outside the box, but this strategy won't work. That is because there's a rule called a first money out rule. The rule says that if you have an RMD due from a retirement account for a year, then the first money out of the account during the year is an RMD. We see that all the time. Therefore, the RMD amount could not be directly rolled over to an IRA. Instead, it must be taken from the plan. Really good question, though. So that's a good question that lays out how convoluted and confusing these things can be. I don't know if you tracked what I was saying or if you followed all of that, but when people try to get creative, it can get really messy really quickly because these rules are difficult to navigate sometimes. So, it's really important. And I don't know, you've heard me say it a million times, there's only 400 of us. It's actually a little over 400 now, and that's great, in this slot group, who have the constant education and support of people like Sarah to answer these complex questions. But there's folks out there that are just kind of, I'll tell you folks, the training you get on IRA distributions, if you're just a series 7 or series 6 or the basic series, is not in depth. if you do a specialized retirement training or a certified financial planner, you get more for sure, but nothing like the education and support you get with the Slott Group. So I am clearly biased about that, but you'll see how these things are manifold and can get confusing very, very quickly. And if you mess up, it can get very expensive because the IRS is typically not very forgiving. So the next question, I was concerning whether or not to do a Roth conversion. I'm 75 years old and in moderately good health. I have RMDs of approximately $120,000 a year. So he's got a significant amount of money, doesn't he, in IRAs. I have two separate IRAs. The RMDs come out of one of the two annually. So he's aggregated, he's combined the two IRAs for the purposes of RMDs, and that's absolutely fine. And so he's taking it all out of one, and he's been doing that for many years. And his question is, can I do my conversion from the IRA that has not had any distribution, presumably after taking the RMD from the other? Thanks for your help over the years. And his name's Tom. So Sarah writes, hi, Tom. The rules say that if you have an RMD for a year that you must satisfy before doing the conversion. RMDs can be aggregated and taken from one of your IRAs. Therefore, you could satisfy your RMD from the IRA that's being converted by taking it from another IRA prior to doing the conversion. That's really, really common. We use with the fixed indexed annuities for principal protection and lifetime income. We don't like to take required minimum distributions out of those while we're doing conversions. So we'll make sure we take the appropriate amount out of the IRAs for a client. We do that all the time. So really great questions. Let me just see if there's any questions about those questions before I move on. I see, Don, I see your hand raised. So if you have a question, type it in the Q&A section, and I'll be able to, because I can't call on you. So now let's go. Let's move on to the market. So I'll give you a quick update, and I hope you should be getting kind of two sets of emails from me. One is, with special event updates and invitations, and then one comes directly from my website, and it's market updates and some other things. So I hope you're getting those. They do look a little different, and as always, I'm open to feedback on those. But what you should have received yesterday is a market update. And I think it's done pretty well. I don't write that market update, I'll honestly tell you that, but I think it's done quite well, and it's quite informative. So let's talk about what happened last week in the market. So this is as of November 19th. So the week ending last week, the Dow Jones Industrial Average was down 1.29%. The SP 500 was up slightly. The NASDAQ was up by slightly, I mean 0.36%. The NASDAQ was up 1.27%. The MSCI World Index, that's not including the US, was down 0.84%, and the emerging markets, all the global indices were really down for the week. So year to date, the Dow Jones is still 18.25, really solid return for the year. The SP 500 26.65. Let's hope that holds for the rest of the year. We don't want another 2018 where we were really doing great and then we ended up with a negative year. The 10-year Treasury was up or down slightly compared to the prior week, 1.55%. So that's some good stabilization there. We definitely saw a drop last week. Some people are attributing to the most recent drop to the renaming of Chairman Powell for to the Fed chair, but really, who knows? Let's talk a little bit about what the analysts are saying. So there are some topics with Prudential, and that I thought were interesting. So Byelich, his name is at Prudential, and he's a really, I think, really logical and well thought out analyst, and the reports are very, very good. And if you ever want one of these, I think I can forward it to you. But if you have an interest, I can forward it to you. So he writes in one of his first bullets that the world economy was on a robust recovery path during the first 5 months of this year. The United States gross domestic product GDP increasing at the fastest rate in decades. Then economic growth slowed abruptly in June, and that's a result of the surge in coronavirus infections and the sudden emergence of supply chain disruptions. I will say that my opinions probably had more to do with sudden disruptions, but it could have been. Then he goes on to write, the reopening of productive capacity that was shuttered earlier in the pandemic was unable to keep pace with the resurgence of demand worldwide. We knew that was going to happen, right? People were holding cash. There was still a lot actually going on during the pandemic, just in a different way. The building trades were very, very active, even with really high cost of goods and waits and delays. What we've certainly learned is that the harder things are to get, the more people want them. Sure. And they seem to have an unending willingness to pay for them. I guess it'll cap out at some point for sure, but it's been pretty stressed. The rapid spread of the the Delta variant. So resurgence of demand worldwide, causing bottlenecks, labor shortages, and widespread supply chain disruptions. It's still a problem. So last Thursday was my last day, my last meeting, my last official meeting, committee meeting for the school board. Last night, I think, was my official last action as I shouldn't say that, probably last official action as a school board director. We had what's called an executive session to talk about a personnel issue, and I think I'm done. I really do. Certainly by December 2nd, another person's getting sworn in, and I'll be done. But some of my board colleagues and I were going to go out after, have a beer and just kind of celebrate my release. But so it was about 9 o'clock on a Thursday, and we had 3 places we had to visit on a Thursday evening in Newtown, which is a pretty busy area typically, before we could go someplace and have a beer because everybody was closing down. So there's still a lot of issues out there. That's very, very small look at it, obviously, but there's still a lot of issues out there. So the shortages are a result of strategic decisions by multinational firms over many years pertaining to globalization and inventory management. In the pursuit of efficiencies, companies reduced inventories to minimum level while expanding capacities overseas in the lowest cost regions of the world. So that was kind of the setup. Let's send things overseas, so everything has to be shipped here, right? Because that's where the cheap labor is, right? Or the cheaper cost of goods, cost of services, let's just say. And then to ship it back to the US, it's actually cheaper to do that. And that's happening all over the world, by the way. And they keep minimum inventory because everything's, we lived in the Amazon world, right? You can have anything almost same day. It's we all used to joke, well, geez, I just ordered that yesterday. It's here already. So that's kind of where everybody was living until there was shutdown. And now inventories are at a minimum. We're shipping things in all over the world. And we've all seen the photos and videos of the ships outside of the California coast, unable to deliver the goods, and heard all the other issues. So when those things happen, we have issues like computer chip issues, because the industry most severely impacted is semiconductors. Computer chips will remain in short supply in the medium term, but shortages could easily ease gradually as the industry steps up production and as additions to existing capacity are completed. So I was just, I track Tesla very closely, and the new Teslas are being built without USB plug-ins in the back seat because they can't accommodate it, which is interesting. Little things like that. They say there's going to be a fix for that later on when they get some inventory back in and they're able to do it. They're going to be able to replace those. But right now, your kids or whoever sits in the back seat can't charge their phones. What are we going to do, right? But that could make an unpleasant road trip if you think about it. So supply side disruptions across many products could worsen in the short term before conditions begin to improve during the middle of next year. Persistent shortages are likely to affect the Christmas shopping season. We've heard all about that, and affect fourth quarter retail sales. That is not an insignificant statement. He goes on to say, and I highlighted this, it is truly impressive that corporate earnings remain in a boom despite widespread shortages of components. the surge in prices of raw material, rising labor costs, and skyrocketing freight and shipping costs. So even though all these costs continue to increase and we're stressed as far as getting components and product, people are still having very, very profitable years. Businesses responded to these daunting challenges through price increases. We're all seeing that, right? I told you about the cost of my brisket a couple weeks ago. Rapid growth in productivity and reductions in overhead expenses. Profit margins in the second and third quarters rose to record levels. We talked about bottlenecks. U.S. firms are likely to ensure availability of materials and components by vertically integrating operations within the U.S. Means more things are likely to be built and maintained inside the U.S. Other countries, I'm sure, will do this too, because they don't want to get caught up in these shipping issues and shortages again in the future. The big question is, what does that mean for the globalization that we really had achieved over many, many decades, and how does that affect the global markets? So you saw the global markets were all down last week, still positive for the year, but it's going to be interesting to see how that plays into 22, 23. At some point, it's going to come back to, people are going to be less concerned about this, but it may take many, many years to get over this concern. And there's already talk of, well, what happens if there's a smallpox virus and we're back all in this again, and what's the next thing? So people are a little concerned. Emergence of a built in America paradigm could reinforce the current capital goods cycle that has gathered momentum as businesses commit capital to new investments in plant and equipment in the domestic market. So that simply, again, just says businesses are going to start focusing again domestically. Now, the patriot in me says, well, that's good, right? Bring business back to the U.S., employ folks in the U.S. That's a good thing. We know, though, that trade is good for everybody. So as long as the pendulum doesn't swing too far one way, globally, the global economy should stay strong. But my feeling is that likely the global markets will suffer while the U.S. markets do better. But don't bet on that, right? And again, don't take tactical bets on that. So the global, we've kind of seen this coming for some time, but just to give it in perspective, going back to the numbers for the year, the global stock market, not including the U.S., is up 13.61%. So if you were betting against the global market, you missed a good opportunity. What really suffered this past year are bonds. The aggregate, the Barclays aggregate bond index, which is what most people use, is down 1.6%. That may not sound like a lot, but when inflation is up 5.4, 6.2 year over year, last one actually, when inflation is up 6.2 and you're counting on these bonds, right, to stabilize your investments and help fund your retirement. And, so cost of goods is up 6.2 overall and your bonds are down 1.6. Well, that's a 7.8% swing. So you've actually lost 7.8% of spendable money in that. And that's tough to overcome. So, Riverfront is another one. Let me just grab that. Yeah, I think I hit everything. They said very similar things. So Riverfront reads, international markets present an opportunity, but need a catalyst in our view. So they're saying there's an opportunity there. I'm saying there's risk there. We believe moderate inflation is a good thing for stocks while interest rates remain low. I don't know where they're getting this term moderate inflation from. Moderate inflation is yet to be seen. 6.2% is not moderate. 14.5% in Medicare costs is not moderate. So I would if I was investing in Riverfront, which I don't, I appreciate their analysis, but I would ask them to go back and identify what moderate means. Now it could be that we talked before about that, and actually Riverfront talked about the real rate of inflation, and they actually say it's more like 2.5 to 3%. So they're taking a different mindset than many folks, and certainly I am. I'm very concerned about the rise of inflation, and this next point is really what concerns me the most about how you overcome rising inflation. It reads, more conservative investors are being forced to own more risky assets to achieve their goals. we believe these risks need to be managed. So when you have conservative investors who are taking much more risk, it can be damaging to their overall plan, because once there's a shock to that risk, and people forget, believe it or not, even though we saw a dramatic drop last summer, people are already forgetting because the markets rebounded very, very quickly. But remember the Great Recession, it was only October 2007 to March 2009, but it felt like forever. So it was only a year and a half, not even, but it felt like forever. And most people will not be able to recover from that, because they're not going to have the stomach for it. They may have the intelligence for it, but often your stomach overrides your intelligence. So those risks have to be managed. You know how I feel about managing those risks. You have to set your foundation, and that foundation is asset allocation, principal protection, and account segmentation. So set that foundation. If there's a shock, like the buildings in San Francisco, you've heard me say this a million times, you'll have damage, but it won't come crumbling down. So very, very important to build that foundation. All right, let's move on, folks. I'm going to share my screen here so so you can see my whiteboard, and so my son knows to index the financial planning piece. Okay, and again, if you see me looking up and looking around, I have several monitors and I'm grabbing things, just like we all do now. All right, so this is financial planning, Roth conversions, and IRMAA we're going to talk about. So raise your hand for me if you can see my whiteboard. Excellent, thank you. So you're going to see me looking down as always, because I'm going to be writing on my whiteboard, and I don't like to try to write, kind of in the air. So I'm going to share a few things with you, but first let's talk about what IRMAA is. So to talk about IRMAA, and again, I'll write it out: income related monthly adjustment amount. So if you're trying to do your Roth conversions on your own, or you're working with somebody who's not considering this, look out, because this can be a real surprise. And this has to do with Medicare costs, right? Medicare Part B. And also D. It could affect your D too if you're so how this works is, remember our tax tables here. So I'm going to draw that graduated cylinder. It's a little squirrely today, but remember we have 10. Let's see if we get the right amount here. 10, 12, 22, 24, 32, 35, and 37. Now these are the current income tax rates. And when do these expire? These expire 12/31/2025, if not before. And it's not necessarily the tax rates expiring, these marginal tax rates expiring that are going to cause so much pain, but it's the income levels that cause that pain. So where we're in the 24% tax bracket for a married couple, that takes us to the top of, or you can do 329,000. It's actually 329,850. So let's just call it what it is. That changes under the reversion, right? So what happens here in 12/31/2025 is that the current tax code reverts back to 2017 levels. So 2017 level becomes 28% here. And it's going to be, adjusted for inflation, about $182,000. So you'll see that there's a big difference between the top of the 28 being 182,000 and the top of the 24 being 329,000. So your money's going to be taxed much, much higher, much, much more quickly under the existing, not proposed, but this is the existing law. It automatically sunsets. So that's important to understand just from a tax planning point of view. So when we're doing Roth conversions, we're trying to fill up whichever bracket makes sense, either to the top of the 22. Again, for a married couple, that's 172,000. $750,000, $750, 172,750, or 172,750, or if you go to the top of the 24, which is, my preference, again, if you really want to get this done, 329,850. So it's important for you to understand this. Again, these are married, so singles. Let me give you singles while we're here. If you're a single person, the top of the 22 stops at 86,375, and the top of the 24 is 164,925. So these are important too, because I was speaking with someone who attended our last webinar class, and he said, listen, I get it, Mark. I think taxes have to go up, but will they really go up? Will they really go up? Well, we all know, right, that they have to go up, and Congress is going to be in a situation where there's no choice but to raise taxes. But certainly look at these numbers. That's not right. What did I do? 180. I have these reversed. I'm sorry. That doesn't make sense. That would be awful. 375 and 164,925. 925. When you go into retirement as a husband and wife, or spouses, then one of you is it's very, 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 very extremely likely that one of you is going to pass in front before the other. So, whether you think taxes are going to increase significantly or not, I don't think there's anybody on this webinar that thinks that they won't. But maybe if you're listening to this recording later, realize that you're going to be suddenly single. It's going to happen where, unfortunately, your spouse passes away. And if you haven't finished your tax efficient planning, if you haven't finished your conversion, or if you weren't sold on the idea that taxes have to increase dramatically, well, just by the death of your spouse, your taxes doubled. Look at these numbers, because the income limitations doubled. You hit these thresholds much, much faster. And believe me, it's much different with the 2017 levels. And remember what the Congressional Budget Office says the tax rates have to be. This goes back many years now to balance things out. And they said you had to have 25, 62, and 88%. 3 tax brackets. Now, if you're living here in the 62 and you're single, boy, that's going to make a big difference. And our studies show that the average middle-class American is going to be in the 40 to 45% effective tax rate within 10 years, or maybe a little bit more. So, but even if everything stays the way it is today, and God forbid your spouse passes, first of the year next year, this is how you're filing as a single filer. So, well, I guess you would have one more year, but very, very soon you're filing as a single filer, and your taxes just doubled because you inherit everything from your spouse typically. All right. So I see a question. I'll get to that in a minute. So let's talk about IRMAA. How does this apply to IRMAA? Well, remember, we think about this as that graduated cylinder from science class. So you have things that flow into here. So let's make these green. Well, first you have any salary that you have, right? Flows into this graduated cylinder and fills it up. Any, if you have rental income, that also flows in. Pension flows in. Social Security, if your Social Security is taxed, there's a portion that'll flow into here as well. And this all builds up. So let's just say that you end right about here with all these things, with all the things we just talked about. So, your basic income. Oh, IRA distributions. We have to count that too. IRA distributions. Typical things that you see when folks are in their 60s and they have retirement. So I have 2 questions. Let me make sure that nobody's saying I can't see it. All right. Gerard, I'll get to your questions at the end. So all these things flow into this graduated cylinder, and it builds up. So now let's just say you end right about here, and that probably puts your effective tax rate at about 18%. And let's, for the sake of argument, say that as a married filing jointly couple, all that adds up to $175,000. So would that work? Let's see if that works. Oh, pretty darn close, right? You would actually be right at 175,000. You would actually be right about there, just over the 24% bracket. So 175,000 is an important number because I'm going to share something with you in a second. No, I'll do it differently. So you end at 175,000 here, and that's, your effective tax rate would probably be somewhere around 18% or so. So that is, you pay some of your income here at 10%, you pay some at 12%, you pay some at 22%, and a tiny little sliver here at 24%. And Gerard's asking if these charts are available. So I think you know that you can go online onto my website and download the charts. I'm going to show you one in a moment. I'm going to show you the IRMAA chart. But if you go to adabarwealth.com and go into the slot corner, scroll down at the bottom, there are several charts that you can download, including the tax planning chart and the Medicare income planning chart that I'm going to be referring to in a moment. So when if you're at 175,000 and then you meet Mark and his team and they say, listen, you have money that you should use, take advantage of Roth conversions. This is the best tool we have for tax efficient planning. And let's just say, for example, I suggest that you do $100,000 in conversions this year. Well, $100,000 will go into this graduated cylinder and fill up here, and it's going to take you, pretty far into that 24% bracket. So that's going to add tax. So maybe you're at 20% or 22% effective tax rate. So you're going to pay tax on that. Let's use 20. So you would pay $20,000 in tax on that $100,000, and that's a separate issue, right? So tax goes out. You have to look at the benefit. The benefit of paying that tax now is compared to paying that tax later. Because remember, if you're at a 20% tax, and I say in the future you're likely to be at a 40% tax, or you're getting 50% off your tax, right? So that's a good thing, and you also have complete control. But something else happens here. Now your income, and this is based. IRMAA is based on modified adjusted gross income. So let's just assume this is where your modified adjusted gross income started. It would actually be your taxable income, so it'd be a little bit different, but let's just assume your modified adjusted gross income ends at $275,000. Well, now you've pierced into the IRMAA charges, because anything above $176,000 for a married couple triggers $59.40 additional per individual, right? So it can be times 2, or it would be if you're both collecting Medicare per month. So that takes your under the current schedule, takes your premium from $148.50 to $207.90. Well, if you go further, and that's up to $222,000. So that we don't quite capture that, do we? We're at $275,000. So once we go over $222,000, well, actually, this becomes $297 even a month. And then if you have Part D, that's an additional $31.80 under the current schedule. So these are additional times 2 per month. So this can add up, right? Let's just do that math real quick. So we're at 297 plus 31.80. So that's $328.80 times 2, right? Times 2. There's 2 of you. $657.60. Now that's per month, right? Times 12. So that's times 12 it. $7,891.20. Holy cow. So folks will say, this is cost, not only is this costing me the $20,000 in tax, but these conversions are costing me $7,809. Let's just call it $8,000. So first of all, we work that into the financial plan to make sure that that we're considering that. So, the idea is you're likely, if you have a significant amount in your IRA, you're likely to pay IRMAA at some point during your lifetime. And it usually happens pretty quickly. And we see that in the financial plan because we compare not doing conversions to doing conversions. But this is something that often concerns people because they'll say, wait a minute, Mark, why don't we do, well, in this case, we could only, and again, we're talking about taxable income compared to modified adjusted gross income. So that's a little in the weeds, but we're just going to use these numbers. Why don't we do 99,000 instead of 100? And that gets us to, no, it'd still get us over, but it would say you'd want to make the adjustment, right? And some people say, okay, why don't we do, let's make it easy. Why don't we do 50,000? And that takes us to 225. And that keeps us, it's still over. All right, why don't we do 40,000? And that'll keep us under the IRMAA threshold. Well, here's the flaw in that. You see what just happened in my math. We went from 100,000 all the way down to 40,000 with Roth conversions. Well, here's what happens. If our schedule says, well, hey, we know that taxes are going to increase in 2025. At the end of 2025, our Roth conversion schedule has you convert it in 2026, or maybe it's 2028. But let's just say, let's use 2028. So our Roth conversions are done, for example. Done. So here's our plan, right? Here's our plan at $100,000 a year. Well, we know taxes are legislated to go up in 2026. If it happens sooner, we've got to address that. But we have what? We have 2 years here of additional risk. Now, ideally, you get it all out here, right? Conversion's done. But as we're getting closer, that's getting much, much harder. If it can work for you, that's great. But if we suddenly say, well, geez, we want to stay under that IRMAA threshold to save $8,000 a year, and we want to knock this down to $40,000, often what we're seeing is, well, now we're talking about getting this done in 2036. Well, now you've increased your risk by 10 years. So what can happen in those 10 years? Well, what can happen is tax rate, right? And it goes up. And each of those years, it goes up. Remember, we're in the middle of it right now. We just saw a 14.5% increase in Medicare premiums. We're seeing other increases. We're getting a lot of proposed tax increases, but we're here now, folks. We're in the middle of these increases, and when they can no longer push, and I think they've pushed Medicare increases pretty much to the brink already. They'll do it again next year, but that's a big jump. When they can't do that anymore, and they can't make adjustments to the IRMAA schedule. And let me just pull this down and share this with you. So here's the IRMAA schedule. Again, you can find this, download it right here on our website, attleborowealth.com/slot-corner. Right here, click in there, you can download it. But these will increase with inflation, these tables, right? That started a few years ago, but they could chop those tables too, and they're likely to. So once they run out of all of that, let me move this back, they're going to come for the marginal tax rates. And that's going to happen quickly. That is not a slow grind. That's going to happen quickly. So every year here that we extend, because we're trying to save $8,000, our tax rate risk increases significantly. And that's often where people go from, running out of money in those charts, right? So here's age 85 to having money to age 100. That 1,000, nobody's living to 1,000. That is the tax rate risk is often what the difference is. So I hope that's making sense. Now I want to show you one other thing before we sign off. I know we're a little over, but I think this is important. So here's an actual comparison that we did for a client, but I took the names and identities off to protect the innocent, right? But I wanted to show you. So this is our terminology we use, base facts, right, in our financial plans. So this is the base facts using assumes inflation for IRMAA and brackets. So they don't pay IRMAA in the first 2 years, and they're doing Roth conversions. So, but in 2023, because IRMAA has this 2-year look back, right? So, and in this client's case, see where it says 2-year look back here. It doesn't start for 2 years until 2023. They did conversions in 2021. Actually, they've not been doing conversions for a little bit, but they turned 65 here in 2023. So they're going to have a 2-year look back. They're not going to pay IRMAA, but I'm sorry, they turn 65 here in 2025. Is that what it is? Oh, well, we had a little name in there, but you're not going to know who that is. Unless it's your chart. But you'll see here's the 2-year, here are the 2-year look backs here. So we turn 65 here. And you'll see that it increases here because now we have the second person. So $9,500 a year. These are not small numbers. 9,500, 5,702. And that's because the conversions are done for one person. We were able to reduce that income. 5,702, 5,702, 5,702, 5,702, and 5,702. And then we're done in 2033 and they never pay IRMAA again. So compared to if they did no conversions, because we say, okay, well, wait a minute. This is a lot of extra costs. Let's look at the bottom here. $61,000 they're paying an IRMAA over that span. These are big numbers from 2023 to 2032. Well, what if we did no conversions? Well, with no conversions, we have very, very small IRMAA amounts. The IRMAA is going to kick in for most people anyway, because you have to take distributions from your IRAs. You have things you want to do. You have required minimum distributions, etc. And that gradually increases. It's probably going to be inflated quite a bit. And in fact, this one, this has inflation in it. It's probably going to be inflated quite a bit because the brackets will change. But you'll see that, look at the difference here, 165,000. 165,889. Just disregard this column. This has to do with no inflation using these numbers here. But this is the column we want to use as B. 61,860 compared to 65,000. So the moral of that story, and there's some charts over here if you're a chart person. The moral of that story is a lot of people are worried about these upfront costs. Because look at the difference here, $9,528 compared to $1,721. You just think, oh my gosh, I'm saving, $7,000 plus a year. Well, look what happens over your lifetime. Well, over your lifetime, $165,000. So compared to 61. So over $100,000 difference. So it's just like anything, you got to do the math. So try not to get caught up in the cost of IRMAA. Of course, it's something you have to pay attention to. But you've got to run it out and do the math and see what the real benefit is. Because once you look at something like this, well, then it's crystal clear. And you have to look at things with projections. One of the things that I championed on my time in the school board, when I first did my first 3 years of budgets that I wouldn't vote for because we didn't have the information. We would do, we're talking about $250 million budgets, and we were just presented 1 year's worth of data. So actually they would tell us how they did last year and then say what we need this year, but there are no forward projections. So at least now the school district has 5-year forward projections because, that's the only way that you can make a real decision. Same with your situation. Well, once you look at this and you say, oh, it makes a lot more sense to pay this now instead of paying it forever, and you make sure that you have everything, you can do what you want to do, you can have fun, you can travel. Of course, it's all part of it. It's got to be planned for. But from a dollars and cents position, you have to look at the totality of the cost. So who wouldn't look at this and say that you're better off doing the Roth conversions in this example? Now, I will tell you that I don't think I've ever had a situation where we've shown this, and now doing the conversions from an IRMAA point of view has been better. But it's good to see that over $100,000 worth of difference. Okay, I hope does everybody see that chart? The IRMAA comparison example? Okay, wonderful. All right, let me take a look. We're over, I know. Let me stop my share and let me take a look at Gerard's questions and the other questions. There are 3 questions on my screen and they're all Gerard. And I appreciate it, Gerard. What rate does current 22 bracket rise to in 2025? I have the 2017 schedule in my desk, and I'll tell you. So the 22, what would be the equivalent of 22 in with the end of the Tax Cuts and Jobs Act goes to 25. What the equivalent of the 24 is goes to 28. What the equivalent of the 32 goes to 33. Then there's added a 35, and then the highest then is 39.6. So that's the answer to that. Does this chart exist to review? I can send you, Gerard, send me an email that I can just send you the tax planning chart I'm looking at, 2017 tax planning chart. Now, what you have to do is you have to adjust these numbers for inflation, because right now these numbers adjust for inflation. So it's for example, I have a note here that 28 is likely going to end at 262,000. So I'm sorry, I did misstate that on my example. It's the 28 starts at 153,000. I think I wrote 178. But last one, does standard deduction amount change in 2025 or sooner? Your standard deduction is going to, well, I don't recall if the standard, we used to have a standard deduction and a personal exemption, and now they just included it in the as a standard deduction. I do think that reverts back. Yes, I do think that reverts back in 2025. All right, good questions. Good questions as always, Gerard. All right, everyone. I hope this was informative. IRMAA is very, very important. It's always considered in our financial plans. Look at the details as always. Don't let it derail you from your plan. Review it, consider it, but you got to stay the course with it, because it's going to add that extra time that's just going to create extra risk. Some people can stay within an IRMAA threshold and still get their work done, but many people, especially people who are just starting, it can be really challenging. Now, one thing I have to caution you, just going back, and I'll share this, I'll bring this back down. Did I lose it? No, here we go. I'm going to bring this back down for a second and share with you my my IRMAA chart. You'll see here, married filing single. Now, this is again the penalty you get for being single. Look at the difference. $88,000 compared to $176,000 is when those first numbers start to hit. 111 compared to 222. Well, that's half. We know these are exactly half. So you're going to get a doubling just by losing a spouse, and spouses inherit typically. So if you have $1 million and your spouse has $1 million in your IRA, or if your spouse has all the money, you're going to get it, and you're still going to be forced to take those required minimum distributions. You don't get a break, right? So you don't pay tax on the transfer, but you still have to take those required minimum distributions at current age 72. But unlike the tax code, where the marginal tax brackets are a gradient, right? So remember, I showed you going slightly into the 24%. These are immediate. Once you cross $176,000, and this is based on modified adjusted gross income, right? It's different than taxable income. But once you cross over that 176, you trigger the next gate. Once you cross over 222 or 111, you trigger the next gate. So that's an area where you can get really close. So if my threshold was 222 and I ended up doing 223, well, that would be a real shame. So you can manage that, but you see how quickly that $100,000 dropped all the way down to 40 in my example. So feel free to download this chart as soon as I have it available for 2022. I'll put it up there. I did share with you the 2022 numbers, and I call them gates at the last webinar. So or you can easily find those if you're interested by Googling. But once I have the official chart, I'll post it up here. All right, folks, it's 11 o'clock. I hope you all have a great Thanksgiving. We'll see you next week. Next week, we're going to talk about the slot report, the slot mailbag, market updates, and for our financial planning topic, we're going to talk about qualified charitable distributions. So that's it for this week. Have a great week, and we'll see you soon. Take care.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.